PCAOB was born out of the Sarbanes-Oxley Act. It was after Enron and WorldCom. It was the first time that the accounting profession had its own regulator. Any firm that wanted to audit publicly and does audit publicly traded companies was subject to registration with the PCAOB and subject to its inspection authority.
But people may not have thought at the time that there would be a relationship to China and Chinese companies. Chinese companies in general, but especially tech companies, have been going and listing in the US on the capital markets there, NASDAQ, NYSE, for 20 years. Like so many other tech companies, they've been drawn to, I'd say, an SEC disclosure-based system where a company does not have to be profitable yet to list and can have things like dual class share structures. And of course, the US has the deepest, broadest pool of capital available out there. Basically, if there is government interference where the PCAOB cannot conduct the audit of the auditor's work, then there is going to be this rule kicking in and triggering potentially a delisting.
A lot of countries raised concerns in their comment letters to the PCAOB about the reach of the PCAOB's jurisdiction. But over time, we negotiated with our European counterparts, some of our Asian counterparts, and I think the assumption was that even in the case of China, that the PCAOB would be able to get to the information it needed to perform its inspection and enforcement functions. And there was a lot of exchanges, a lot of in-person exchanges, both here and in China with the Ministry of Finance and with the CSRC at various levels. And we came to this understanding under the MOU, which was enforcement focused. It did not encompass the inspection function, but the idea was to set up a mechanism. And the mechanism allowed for the US side, in our case, the PCAOB, to get access to audit work papers. Now, the MOU specifically contemplated that the Chinese side would be able to review the work papers for purposes of determining whether the information in those work papers contain state secrets.
There's no shortage of Chinese companies which continue to go public in the US. And is that it almost strikes me as that they just assuming that this issue is going to get resolved. And what's your take on that?
It's hard to tell. I'm not overly optimistic. And I say that because there's principles at work on both sides which are really important to each sovereign. Let's start with the US side. We view this as a very simple requirement, basic, foundational to our capital markets. It's been in place for now, as you said, almost 20 years. And it's access to work papers, to audit work papers. So from the US perspective, it's not a particularly intrusive requirement. We're not asking for trade secrets. We're not asking, the US side isn't asking for trade secrets. It's not trying to get into, it's not necessarily interested in sensitive information. It's the type of thing that auditors actually in the United States, if they're auditing a defense contractor that's publicly traded, they have to be careful about what they access. And when they do access classified information, it's not going to show up in their work papers, right? So we're used to dealing with sensitive topics in the context of the public company audit. So the US side's position is the rest of the world appreciates the US need to oversee the accounting profession this way, to improve audit quality and protect investors. And it seems to be working pretty well. It hasn't disrupted markets. It hasn't disrupted unnecessarily how people view the public companies that are inspected, whose audits are inspected. Now, on the Chinese side, there's a very different principle at work, which is we have our own view about what information our public interest entities, which are state-owned, but are private entities as well, and what information we want leaving the shores of China. And we have a very different idea about what we think is in our best interest to protect. And we need that principle honored in the course of our commercial dealings. I think the US side thought there was a little more give here. And the reason we thought there was more give on the Chinese side was, for example, when a Chinese pharmaceutical manufacturer is producing drugs for the US, the FDA is allowed to send inspectors into the factory. Or when San Francisco had a contract to build the new Bay Bridge, and the steel was being supplied by China, they sent inspectors over to inspect the steel manufacturer. But I think as the Chinese economy matured and continued to grow and get more sophisticated, I think they saw this audit requirement as being overly intrusive. And they really believe, to this day, that they can supply a vast majority of the information, but they need some say. And I think the US side doesn't want to assume the risk that if something's withheld and a Chinese company turns out to have financial reporting issues, that people will say, well, the US regulator agreed to a compromise and it didn't see what it was supposed to see. And now US investors are harmed. And I think we're at a point of brinksmanship on for both sides. And and I know you're going to get to this, Art, but if Chinese listings have an off-ramp, if they have an alternative where they eventually can get to liquid markets, where they eventually can get access to a broad base of investors and maintain their cachet, their overall cachet. The US system has this cachet that I think is unrivaled. It also has protections that are, I believe, unrivaled. But if they're able to accomplish this in other markets as a Chinese-based company, and the attractiveness of an investment in Chinese companies are maintained, I think it's very hard for the US system to accomplish what they're trying to accomplish. And that's why the law is so important. It's now an automatic trigger. The regulators really can't avoid the issue anymore on the US side. And the Chinese side is forced to decide how much do we want to work with the American side on this in order to maintain access.
It really is a bit of a microcosm for the broader relationship and maybe some of the breakdown of the trust that's there, because what this whole mechanism is straightforward, but as you've kind of alluded to too, it does rely on a certain amount of trust. So for example, maybe from the Chinese side, trust that the US really is only after certain kinds of papers and not interested in others, as you said, which I certainly believe that's the case. But from the Chinese perspective, of course, they're not going to give the benefit of the doubt. And from the same side, the US side is not going to give any benefit of the doubt to China that certain things are being not fully disclosed and so forth, or full access is given. And I think so much of that depends on trust, and we're not in a very trusting environment right now.
The Ministry of Finance and the CSRC share that authority. The Ministry of Finance is more focused on Chinese auditors that operate in Hong Kong and in other jurisdictions, and the CSRC is focused on the domestic based auditors. And they've shown some interest from an enforcement point of view in bringing cases against China-based accounting firms. But what they haven't shown an interest in is looking at the audits of the China-based companies listed here. And they have historically said, and this makes sense to me, look, the foreign markets accepted these companies, they're not listed here, and you have to worry about those companies' disclosures and their audits because they're not based here. They're not operating in our capital markets the same way. Now, when you start having dual listings in both Hong Kong and the United States, I'm curious whether that approach is going to be maintained, and whether the CSRC and MOF may start thinking differently about those audit firms and those audits.